The fabled dividend snowball, sought after by both veteran investors and newbies alike for its compounding effect and massive results. Before we get into the details, we're going to hear from Warren Buffett on compound interest and his thoughts.
Einstein is reputed to have said that compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things.
Alright, so what is the dividend snowball and how can you use it to your advantage? So first of all, a dividend snowball is a continuous cycle of growing dividend income. It is created by investing in shares of dividend growth stocks. So a bit of a disclaimer on this, it doesn't exactly have to be dividend growth stocks, it just really needs to be dividend stocks. And then this principle really underlies and lies upon the effect of compound interest. So compound interest refers to the ability of a sum of money to grow exponentially over time by the repeated addition of earnings to the principal invested. And the principal is the initial amount, right? Or the base that's earning the interest on the income. When looking at an example here, it's really important to note what a dividend yield is. So when you're choosing dividend stocks, and we'll have a look at a few at the end, it's important to see the yield, which is the percentage of return you get on the value of the stock, right? So a dividend yield is dividend per share, or DPS, over the share price. So in other words, how much they're paying per the price that you paid for the share, right? So we're going to look at one example here of how this dividend snowball actually works and how you can see it kind of escalates and gets bigger and bigger, like the snowball kind of running down a cliff, right? So stock A. So if stock A is worth $10 and you buy 10 shares, so you've invested $100 in the 10 shares. If that stock pays a dividend yield of 10% with underlined here, so that's quite a high amount, right? But there are a few out there. That would mean every year you're going to get $10 for the $100 you invested. Here is where the snowball comes in, okay? So the next year, instead of having $100, you have $110, but you're still getting that yield of 10%. So therefore, you're getting $11. And then again and again and again, you're getting, 12, 13, 14, 15. And then over time, you're getting a lot more dividends. So this is how compound interest works, is you get the return and you have to reinvest that return. So i.e. the $10 or $11 here into the principal, the main amount. And then you just get more and more and more and more as you invest in the stock. Now, there are a couple of key principles that I want to call out when it comes to this type of investing, right? So the first thing is, before we get into the key principles, is, you're going to have to pay a little bit of tax on those dividends, and depending what country you're in or what kind of stocks you're buying, it varies. For example, if you're buying US stocks and then you're living in Europe, your country might have a treaty with the US, you pay, less. Rather than 30%, you pay 15%. So a couple of keys here I want to call out for this dividend snowball to actually work, right? So first of all, you have to get started. So you have to start with an amount, but you could buy a stock for $10, right? And that's going to pay you a dividend. So getting started is key, getting over that kind of initial fear or that those risks going around your head of getting a return, putting that money in, choosing a good broker, etc. Next up is consistency. So you might have seen from some of my stock updates that I consistently put an amount in every month, okay? So that comes automatically out of my money every month, and it goes straight into the stocks that pay me a dividend. So it's really important to get started and then be consistent with how much money you're putting in, and of course returning the amount that the dividends you're making into that principal amount. So that's the reinvestment bit, right? So every time you get a dividend, instead of taking it out and spending it, you're putting it back into the original amount, and then you're going to get more dividends next time. And finally, patience, right? So I think when I started off with like $250, okay? And now I'm up at about $5,000 within like six months, and I've gotten dividends out of that. Take a look at my stock updates or my portfolio update video if you want to see that. But you got to be patient. This is, there's no easy way of getting an investment right, of getting an investment to work for you. I would more like to say is getting a return on it. So you got to be patient. You got to get started. You got to consistently reinvest the dividends. Okay. So we're going to move over to my broker now, and I'm going to show you a few dividend stocks and where you can kind of see the yield and stuff like that, just to kind of outline that kind of thing. So coming on to my broker here, Trading 212, and most brokerages are the same, right? You'll have a search option or whatever, but I'm just going to go through a few offhand stocks that I get a dividend from. So we'll start with Altria, right, which is the highest dividend yield that I have. So you can see that the principal amount invested would have been $44.42. Then yearly on that, you can see the dividend yield here is 8.36, okay? So that's how you calculate it, is the principal is the initial amount, and then the yield is the percentage of that amount you're going to get on a yearly cycle. Now usually you get, not all stocks pay yearly, but the dividend yield is yearly, so you might get paid monthly, you might get paid quarterly or yearly. Just to highlight as well, so this one is quarterly. One great one for getting a monthly dividend is Realty Income. So the principal would be $62.55, and then the yield would be 4.87%, right? So that's what you're going to be getting yearly, but they're going to pay you monthly. So I'm going to finish up there. I'm very open to questions in the comments if you have questions on this, and I'll catch you in the next one.